Diversification is an investment concept that could accelerate your path to financial independence. It's a process of allocating capital by investing in a variety of assets. Simply put, diversification means not putting all of your eggs in one basket and instead placing fewer eggs into many baskets. If the eggs in one basket spoil, you don't lose the entire portfolio. Now, it doesn't necessarily mean higher returns on your investments, but it could mean a smoother, less volatile ride that may help you endure market contractions more easily. It seems everyone today wants to compare their investment returns to the S&P 500 index, which measures the performance of 500 large U.S. companies listed on the stock exchanges. The problem is the index is tracking only large cap companies, one basket of eggs. So if you're only invested in large cap companies, your investments will move up and down in tandem with the large companies. Keep in mind, there are also mid-cap companies and small cap companies and international companies, but I can only juggle 3 at a time. Don't get me going on 4 for sure, that the S&P doesn't consider. To diversify your portfolio, you would include the various sectors on both the equity or the stock side, where you own part of a company's profit, and the fixed income or bond side, where you own a portion of the company's debt. During the December 2007 to 2009 financial crisis, the S&P plummeted roughly 35%, whereas a 60-40 somewhat diversified portfolio, fewer eggs, one basket, meaning in this case, 60% in the S&P stocks and 40% in 10-year treasury bonds, to keep things simple here, fell just over 15%. So less than half. Would you have remained invested if your portfolio was down 35%? Could you have stomached even a drop of 15%? Perhaps that would have been too much for you also, but you may have had a better chance of sticking it out, because missing even a handful of the best investing days could really hurt your long-term returns. If you had sold all your investments at any point along the market downturn, would you have known when to get back in? Market timing's hard. Nobody seems able to do it consistently well over long periods of time. Now, before you run off and say, all right, hands up, 60-40 it is, you should assess your investment risk tolerance. You may find that you're more or less risk tolerance than a 60-40 portfolio will provide. Now, if you feel the urge to shift everything to cash at the first sign of bad news, you may want to consider lowering your overall risk so that you remain invested. And then at the other end of the continuum, there are investors looking to take on more risks. Cryptocurrency, anyone? Ironically, the only question people seem to be asking is, how do I buy fill in the blank coin? Nobody's asking, should I buy it? What are the risks? Because yes, indeed, there are some risks. It's a new asset class. It's volatile. It could be and probably will be regulated at some point too. So there's a lot going on with it. Can this asset class be part of your diversified portfolio? Maybe. Scroll down to the article and find out.
If I had $1 million, if I